5 essentials you must know about every stock you purchase. Investing money into various investment vehicles may initially seem straightforward, but achieving success as an investor can prove to be a difficult task. Retail investors, who are not investment professionals, often experience financial losses each year. While several factors contribute to these losses, one aspect that resonates with all investors outside the investment market is the lack of time available to research numerous stocks and the absence of a dedicated research team to assist in this monumental endeavor. The underlying message is clear: without conducting adequate research, investors are likely to face significant losses. However, there is positive news. By focusing on key factors of investing, it is possible to reduce losses and minimize the extensive research burden. In the following discussion, we will explore the importance of thorough research and delve into 5 essential aspects that can enhance investment outcomes. By emphasizing the significance of research in making informed investment decisions, individuals can mitigate risks and increase their chances of achieving favorable results. Hello everyone, welcome back to our channel Study with Focus, and in today's lecture, we are going to learn about 5 essentials you must know before investing in any stock. 1. Understanding the company's business. Investors should exercise caution and avoid purchasing stocks without having a comprehensive understanding of how the companies generate revenue. It is essential to delve into details such as the company's manufacturing activities, the services they provide, their operational presence across different countries, and the performance of their flagship products. Evaluating whether the company is regarded as a leader in its industry is also crucial. This initial step of gathering information is akin to a first date. Just as you wouldn't go on a date without knowing anything about the other person, investing without sufficient knowledge about a company can lead to trouble. Fortunately, acquiring this information is relatively straightforward. Utilizing a search engine of your choice, visit the company's official website and thoroughly explore the content provided. This will offer valuable insights into their operations, products or services, and market positioning. To test your understanding, discuss the potential investment with a family member or friend and see if you can confidently answer their questions. If you can provide comprehensive responses, it indicates that you have gained a sufficient level of knowledge about the company. By investing time in learning about the company's core activities, investors can make more informed decisions and have a better grasp of the risks and opportunities associated with the investment. 2. Price to earnings, PE, ratio. To grasp the concept of the price to earnings, PE, ratio, let's imagine you are considering 2 financial advisors. The first advisor has a long and successful track record, generating substantial returns for their clients. They have earned the trust of your friends, who have experienced significant financial gains. This advisor charges a fee of 40 cents for every dollar they make for you, leaving you with 60 cents. On the other hand, the second advisor is relatively new to the industry and lacks an extensive track record of success. However, they offer a lower fee, keeping only 20 cents for every dollar they make you. The trade-off is that their performance may not match that of the more experienced advisor. The essence of the PE ratio lies in understanding this comparison. It is a financial metric used to assess a company's current share price in relation to its per-share earnings. By comparing a company to others in the same industry, analysts and investors can gauge its relative value. For instance, if a company has a PE ratio of 20, investors are willing to pay $20 for every $1 of earnings generated by the company. This may appear expensive at first, but if the company is experiencing rapid growth, the valuation could be justified. The PE ratio is calculated by dividing a company's market value per share by its earnings per share. It provides insights into how the market perceives the company's earnings potential and growth prospects. A higher PE ratio compared to similar companies may indicate that investors have high expectations for the company's future performance. However, it is crucial to assess the reasons behind the higher ratio. Conversely, a lower PE ratio combined with strong growth rates could suggest an undervalued investment opportunity. When researching a company, it is essential to compare its PE ratio with similar companies in the industry. If the company has a higher PE ratio, it is crucial to analyze the underlying reasons. There should be justifiable factors supporting the premium valuation. Conversely, if the company has a lower PE ratio but demonstrates robust growth potential, it may indicate an investment worth monitoring. By incorporating the PE ratio into your investment analysis, you can gain insights into the market's perception of a company's earnings and growth prospects. However, it is important to consider other financial metrics and factors alongside the PE ratio to form a comprehensive understanding of a company's investment potential. 3. Dividends. For investors who don't have the time or desire to closely monitor the market on a daily basis, dividends can be an attractive feature to consider. Similar to earning interest on a savings account, dividends offer a regular stream of income from stocks, regardless of their price fluctuations. Dividends represent distributions made by a company to its shareholders as a way to reward them from its profits. Typically, the company's board of directors determines the dividend amount, which is commonly paid in cash. However, some companies may choose to issue dividends in the form of additional stock shares. Dividends hold significant value for many investors as they provide a steady income stream. Most companies issue dividends at regular intervals, often on a quarterly basis. Investing in dividend-paying companies is a popular strategy among traditional investors, as these dividends can provide a sense of security during periods of economic uncertainty. The most desirable dividends are typically offered by large, established companies that exhibit predictable profitability. Sectors such as oil and gas, banks and financials, basic materials, healthcare, pharmaceuticals, and utilities are well known for housing companies that issue dividends. It is not uncommon to find high-quality stocks with dividend yields of 6% or even higher. However, it's important to note that companies in their early stages, such as startups, may not have generated enough profitability to offer dividends. Before purchasing stock shares, it is essential to assess the company's dividend rate. If you are seeking a stable investment option, consider investing in stocks with a high dividend yield. However, it is equally important to conduct thorough research and analysis of the company's financial health, stability, and growth potential to ensure that the dividends are sustainable in the long run. Dividends can be a valuable component of an investment portfolio, providing a consistent income stream and potentially enhancing overall returns. By investing in companies with a history of issuing dividends and strong financial fundamentals, investors can benefit from the regular income and potentially mitigate the impact of market volatility. 4. Beta. Understanding beta may initially seem complex, but it's actually quite straightforward. Beta measures the volatility or the level of fluctuation exhibited by a company's stock over the past 5 years. Essentially, it quantifies the systemic risk associated with a particular stock in comparison to the overall market. The beta value can typically be found on stock research pages, such as those on Yahoo or Google, alongside other key metrics like the PE ratio. To grasp the concept of beta, imagine the S&P 500 index as a pillar of stability representing the broader market. If a company's stock price experiences larger drops or rises than the index over a 5-year period, it signifies a higher beta. In the context of beta, a value higher than 1 indicates high volatility and consequently higher risk, while a value lower than 1 represents a lower level of volatility and lower risk. While beta provides insights into price risk, its implications for fundamental risk factors may not be as significant. High beta stocks require careful monitoring because while they have the potential for substantial gains, they also pose a greater risk of losses. On the other hand, stocks with lower beta values are considered defensive stocks since they do not react as strongly to movements in the S&P 500. Investing in lower beta stocks provides a relatively safer investment as the potential for significant losses is reduced. However, it's important to note that the trade-off is a potentially slower rate of returns. In this case, investors may not need to closely monitor their investment on a daily basis. In summary, beta serves as a measure of volatility, allowing investors to assess the level of risk associated with a particular stock compared to the broader market. By understanding a stock's beta, investors can make more informed decisions and align their investment strategies with their risk tolerance and investment objectives. It's crucial to balance the potential for higher returns against the associated risks when considering stocks with different beta values. 5. Understanding your risk appetite is a crucial aspect when it comes to investing. It is important to recognize that investments in the stock market, including online stock trading, do not guarantee reliable or guaranteed wealth accumulation. There are inherent risks involved, and it is essential to determine the amount of potential loss you can afford to bear within those risks. By understanding your risk appetite, you can focus on investments that align with your financial goals and tolerance for risk. Determining your risk appetite involves evaluating your financial circumstances, investment goals, and personal preferences. This assessment allows you to identify the level of risk you are comfortable with and helps you make informed investment decisions. It is crucial to strike a balance between risk and reward, considering both potential returns and potential losses. Once you have established your risk appetite, you can tailor your investment strategy accordingly. One approach is diversifying your portfolio, which involves investing in a variety of assets or securities. This strategy helps mitigate risk by spreading investments across different sectors, industries, or asset classes. By diversifying, you reduce the impact of any single investment's performance on your overall portfolio. For investors seeking safer short-term investments, debt instruments such as bonds or fixed-income securities are often considered. These instruments provide regular interest payments and are generally considered more stable. On the other hand, for long-term savings goals, options like gold, equity mutual funds, and safe stocks are often recommended. These investments have the potential for growth over a longer period and can help build wealth over time. For more experienced investors who are willing to take on higher levels of risk, opportunities lie in areas such as commodity trading, futures and options, F&Os, and day trading. These strategies involve more active and speculative trading, which can offer greater potential returns but also come with increased risk. Remember, it is important to continually reassess your risk appetite as your financial situation and goals may evolve over time. Regularly reviewing and adjusting your investment portfolio based on changes in your risk tolerance can help ensure that your investment strategy remains aligned with your objectives. In conclusion, successful investing requires a thorough understanding of key factors such as company research, price-to-earnings ratio, PE, dividends, beta, and risk appetite. By conducting proper research on companies, investors can gain valuable insights into their operations, products, and market position. Evaluating the PE ratio helps determine a stock's relative value and growth potential. Dividends offer a steady income stream and can provide stability during uncertain times. Beta measures a stock's volatility compared to the market, allowing investors to assess risk levels. Lastly, understanding one's risk appetite helps tailor investment strategies and determine the suitable mix of investments to achieve financial goals. By considering these essentials and aligning them with individual circumstances, investors can enhance their chances of making informed investment decisions and maximizing returns while managing risk. That's all for today's lecture. Hope you learned something new. See you in next video.